Futures are higher right now after stocks hit an air pocket last week. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, it's a big week for central banks. We'll get a flurry of decisions with the Fed leading the way on Wednesday. We also have fresh data released this week. It may show that the U.S. economy is humming along. And later this hour, we'll get PMI data followed by retail sales tomorrow. Plus, move over Supermicro because here comes MicroStrategy, the software maker that's heavily invested in Bitcoin, set to join the NASDAQ 100. All of that and more coming up, but let's take a look at where markets are trading right now. You can see we're a little bit higher. Of course, the S&P 500 finished lower last week. That is after 3 straight weeks of gains. You can see higher to the tune of about 0.4% right now. You do have big tech leading the action in the pre-market with the NASDAQ 100 up about 0.6% and the bond market. This has been an interesting one. You do have 10-year yields a little bit lower right now, but they rose by 24 basis points last week, Sonali. That was the biggest weekly jump this year.
Just incredible. And you saw that sigh of relief in the market. You are now seeing a hop up on a big week. We're going to talk a little bit more about that. We're going to watch some stocks in particular this morning. Katie was talking about Supermicro Computer, now down almost 12%. It will be removed from the NASDAQ 100 next week, and it will be replaced by MicroStrategy, which has risen more than 500% this year. It has a market value around $100 billion, still on the rise, up about 3.8% pre-market. Also keeping an eye of Capri after a report that the fashion company is working with the bank to find buyers for its Versace and Jimmy Choo brands. You have Capri reacting positively, up more than 4.6% after, of course, its failed deal with Tapestry, Katie.
All right, a lot to keep an eye on there at the single stock level. And this is an interesting one. It is really the last week that matters of 2024, at least from a market's perspective. Of course, we have the Fed on Wednesday, all eyes there, but it's still earnings season. We have Micron, Nike, FedEx coming up all over the next 5 days or so. So it's not over, Sonali.
It's not over. We're going to touch on all of that throughout the week. I know we're going to touch on the retail sector a little later today for those who are interested. Big bid in consumer discretionary. But it's kind of hard to say, Katie, that not all eyes are mostly on the Fed this week. As exciting as a lot of those single stocks are, that macro picture, the dot plot ahead going into 2025 as we posture, I think is going to be the really big story as we close out the year.
Exactly. It's not so much this decision that we're getting this week. We know the Fed's going to cut rates, but what they do in 2025 is an open question. So let's explore some of these themes now, because joining us is Boivin. He is head of BlackRock's Investment Institute. His latest note on the 2025 outlook says, quote, "We think investors should focus more on themes and less on broad asset classes as megaforces reshape whole economies." And I thought this was so interesting, John, because I've been saying for a while that this is a narrative-driven market more than anything else, it feels like. So if you take that approach, sort of that story-led, that narrative-led approach, where does it leave you? What are you focusing on?
Yeah, so the main point here I would start with is that this is not a cycle, right? So we've been spending the whole year thinking about soft or hard landing and the Fed and that context, and we're going to hear this week, of course. But we've been of the view that this is not really the right framing. This is not really about an expansion that can turn into recession. It's rather more about a transformation, big forces that are transforming the economies. And that leaves us, paying attention to the AI team. That's clearly like a big story. We think that there's more opportunity in 2025 there to be generating returns. It's about, geopolitical fragmentation that's going to have implications, energy transition. So these are all these things that will have profound effect across asset classes. But they're not like a cyclical story.
So when I hear transformation, when I hear AI, I think tech, and I think tech stocks in particular. But is that too narrow? Where else can you broaden that to?
Well, it starts there for sure, because we're in the first phase, right, which is right now to build out this AI capabilities, these factories of intelligence. As we build that out, we need to build it out first before we really get the application. So during the course of 2025, I guess that's going to evolve towards the applications, the phase 2, and trying to get more visibility on where we're going to see the big benefits and the revenue streams out of this. And I think that's where like the active management will and the skills will matter more in 2025, whereas now it's mostly about the build out and a few companies.
If you believe in the benefit here, the heft of a few companies, and if you think about the AI promise that many investors have been betting on through the course of this year, what do you then tell investors, Jean, of the people who are betting on the broadening trade? Do you believe in it?
Let me start by saying that the concentration we've seen in the S&P 500 and the markets more generally is kind of a feature of this transformation. It's not necessarily a bug. So I guess the first thing that I would say is that like you need to be careful to be reading too much in the concentration as being a red flag. So in fact, we think it's a feature, not a bug, as I said. And eventually we think it's going to broaden out, but that might take some time. So I think like not get too nervous about the concentration is the first point, and be on the lookout for broadening out over the course of 2025. But that might not happen overnight.
The NASDAQ 100 alone is looking at gains of almost 30% so far this year. And in your 2025 outlook, you had written that you don't think a pricey U.S. equity valuations alone will trigger a near-term reassessment. So if you're thinking about those risks ahead that would trigger that reassessment, what might those things be?
So we are positive going into 2025 in the broad risk asset performance, and even despite the valuation, as you say, we tend to favor U.S. equities. We've increased our overweight, in fact, to U.S. equities. But what the risk we're going to be watching out for in 2025? I guess there are mainly along two dimensions. The first is, and you've talked about at the top of the hour, the rate repricing. We think rates are likely to go up, long-term rates from here. We don't think the Fed's going to be able to cut much more rates, in the near term. So there's a risk of maybe a more abrupt increase in yields, and that would be disrupting the risk asset and equity. So one thing to watch out is a disorderly, adjustment in rates. And then the second thing is everything that has to do with the tariff landscape and protectionist measure around the world. It's difficult to see an equity market that's going to continue to perform if we have like the most bold version of these tariffs being seriously contemplated. So these are the two things we will be watching in 2025.
Well, let's dig into that first point because, Chanel, you were off on Friday, but we had a conversation with Mike Wilson over at Morgan Stanley, and he made the point that one of the biggest risks next year is basically what you're saying, that the Fed can't deliver on what's priced in when it comes to the rate outlook, and that you do see some indigestion, you could call it that, at the long end. But when does it start to hurt from a levels perspective? Because on the 10-year yield, we're hanging out around 4.30. We've seen 4.5. We haven't seen 5% in a while. Where is the pain point?
So we think that like this growth backdrop, this earnings, the fundamentals for equities are pretty strong, and I think it's not about like traditional macro, I guess, as I meant from the beginning. It's really about like this AI transformation, and there's a solid basis. So that gives a room for rates, we think, to adjust upward without fundamentally changing or undermining the equity performance for 2025. So I don't think there's a level per se that's going to be a trigger point. I think it's going to be more about the speed of adjustment. If there's a sudden wake-up call and we think that inflation is much higher than we thought, that the Fed has to stop for a long extended period of time, that in the near term could lead to a more rapid adjustment. So I think it's the speed of the adjustment that would be disrupting in the near term. But I think we can sustain rates moving slowly towards closer to 5% over the next few years, and remaining more or less there without ultimately sustained damage to equities.
That concern, sorry, go ahead.
Well, just to draw that point out a little bit more here. So I get what you're saying, that it is the speed of the adjustment. It's not the absolute level necessarily. And if it is AI, for example, and that disruption theme that's sort of driving the action there, in a sense, is that macro proof? Is it insulated from some of the things that we're focusing on here when it comes to the Fed?
I don't think it's macro proof necessarily, and yes, as rates adjust, there's going to be different arithmetic that will need to be accounted for when you think about the project that will need to be financed and the big infrastructure spend. But I think that the size of it, the scale of the build out that is needed, and the opportunity that this is going to create, I think will make that pretty resilient. And unless we have a very abrupt and sustained rate rise, we would think that this is not macro proof, but pretty resilient.
Jean, if you think that you can get to 5% sustainably and you believe that rates could be higher, you're worried about the bond market investing in it right now, what do you think the factors are that would get you there? Is this mostly a result of the government deficits we're seeing and people needing that term premium to be higher at the end of the day? Or do you think that there are real worries about persistent inflation under the surface that need to be accounted for?
I think it's a combination. The first is I would start with the inflation outlook. We've been of the view, for more than a year that this inflation is much more persistent than is hoped for, even by central banks. A lot of the progress we've made was due to mainly two things. One was the post-pandemic normalization and a very favorable immigration story in the labor market. Both of these things will not continue in 2025. And underneath, the protectionism we're seeing and so on, I think there are real inflationary pressures that are going to continue. Not massive inflation, but it's going to be surprising on the upside. That's going to prevent the Fed to really cut rates much more. We never thought this was an easing cycle that was starting, and it's more of a recalibration. I think it's going to become clear as we get into 2025. And then we have the broader story, as you mentioned, around the term premium, which is extremely low compared to the inflation risk we're seeing long term, compared to the deficit trajectory. So these things, I think at some point, there's a bit of a shift in narrative, and it leads to investors requiring a bit more of a higher rates in this environment.
Difficulties in adjusting to that last mile. Jean Boivin, head of BlackRock Investment Institute, we thank you for joining us this Monday morning. Now let's get a look at some of the stocks moving ahead of the opening bell. We're going to bring in for that Abigail Doolittle.
Well, let's take a look and start here, Sonali, with the shares of Broadcom. After last week's big week, we had the best day ever on that good outlook, very good outlook for AI demand. The stock having, again, its best day since 2009, record highs. We have more gains, up 3.1%. A piece of this, just that momentum continuing, investors wanting in on what they're talking about with the massive AI demand. But Bernstein also naming this one of the top chip stocks for the year ahead, plus NVIDIA. Turning to a stock that's trading to the downside, though, we have Tenet Healthcare down a little more than 1% at this point, actually closer to the better part of 2%. This is Goldman Sachs has downgraded shares to a neutral, not because of valuation necessarily. The stock into today up a very, very healthy 81%, but because of policy uncertainty. So the firm is taking a more cautious view on healthcare providers. They've also cut United Healthcare to a neutral as well. And then finally, Bitcoin last week up for an 8th week in a row. Actually, this week it's up for an 8th week in a row, heading to the longest winning streak on a weekly basis, going all the way back to 2017, above $100,000 per Bitcoin. MicroStrategy being added to the NASDAQ 100. Well, that's put another fire beneath the crypto space. All of these crypto names, Katie, you can see are trading higher.
All right, and what a nice segue, Abigail Doodle. Thank you for that, because coming up, MicroStrategy, as Abby mentioned, getting the thumbs up to join the NASDAQ 100. We'll take a look at all of the changes coming next Monday. This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. China's retail sales growth unexpectedly weakened last month. The slowdown highlights the urgency for Beijing to encourage residents to spend, especially after the re-election of Donald Trump. The threat of a new trade war could diminish the role of exports as a growth driver for China. Meanwhile, Starbucks has hired its first ever chief growth officer in China. Tony Yang is tasked with luring back young coffee drinkers as the U.S. chain sees challenges in its biggest international market. Starbucks was once seen as largely infallible in China, where customers flocked to Western brands, but it has been struggling as cash-strapped diners pull back on pricier drinks in favor of cheaper local upstarts. And the European activist firm Bluebell Capital Partners is shutting down its hedge fund because the size of its fund wasn't large enough to justify the administration costs. Bluebell made a name for itself in investing in European companies like Bayer, Lufthansa, and Danone, where it successfully engineered the removal of its CEO. Not all campaigns were, however, successful. It also called for the ouster of Larry Fink at BlackRock and demanded a shakeup at Richemont, moves that were rebuffed. Bluebell will continue to pursue its activist strategy through co-investments and advisory mandates. Katie.
All right, switching back to the States, let's talk about the NASDAQ 100, scheduled to rebalance next Monday morning. And the bombshell, of course, from Friday night is that MicroStrategy, Palantir, and Axon are set to join the index. Let's take a look now at what's in and what's out with Bloomberg's Bailey Lipschultz. We'll start, of course, with who got the thumbs up, and we have to start with MicroStrategy because this was a bit of a controversial addition, if you want to call it that.
Very hotly debated, Katie. And just to be blunt, this is a company that sells shares and sells convertible debt to go out and buy Bitcoin. The underlying software business loses money. There's a reason that currently it's not eligible for S&P 500 inclusion, which is something that they will address with new accounting rules, potentially to be included. But it's very different relative to the other companies, namely Palantir in the defense tech space, or Axon, which is the company that makes tasers. So very different companies that are being added to the NASDAQ 100, and a lot going on with Michael Saylor and MicroStrategy.
Now, I think it's really interesting to see some of the stats behind this. This is in your world, Katie. MicroStrategy entering the NASDAQ 100. Bloomberg Intelligence expects net buying of $2.1 billion in shares by ETFs to follow, equal to about 20% of the daily volume. But could you get, if you get it into the NASDAQ 100, what are the prospects of it to get into the S&P 500 at some juncture?
Well, the big thing is, so it's currently not eligible for the S&P 500, but because there will be new, this is reading a note from Bernstein, they will, with new financial accounting standard board guidance for the treatment of Bitcoin held on corporate balance sheets in 2025, they could immediately start to position themselves being positive earnings based on if Bitcoin goes up, then they can count that at least on their balance sheet as being positive. But the big question is going forward, how much does this buying impact the stock? And also, do your average investors or your average people who are just putting money in an index fund really want to have exposure to a MicroStrategy?
So I have 2 points here. One is we'll be speaking to Michael Saylor on Wednesday morning, so looking forward to that. Number two is that it's not just, passive buyers who are buying the index. I actually spoke to Tom Lee from Fundstrat last week, and he said to me in his new ETF, he wants to buy MicroStrategy. He will buy MicroStrategy if it's added to the index because they have certain rules that they have to be in an index.
Well, that's the interesting debate when I talk to bankers about IPOs, potentially in the crypto space. Everyone's looking at Circle. If your mandate is to buy stocks, you can't buy IBIT. You can't go out and buy Bitcoin. So you want to buy the next best thing. For certain portfolio managers, MicroStrategy checks that box. But again, the debate and the reason, Katie, going back to the whole discussion going into the announcement on Friday, if your underlying business isn't really tied to actual fundamentals and it's tied to kind of being a proxy for Bitcoin, what does that serve in an ETF?
When we're talking about the companies entering the index and the ones exiting, Supermicro troubles this year have been widely documented.
Amazing story.
Amazing, and the volatility has been incredible. We've also reported here at Bloomberg just a couple of days ago that they're looking to tap Evercore to raise capital. And if you don't have that boost here of all of these passive funds behind you, what happens to other investors you're trying to bring in the door?
Well, that's the big debate, Sonali, and that's kind of another company that's getting the boot in Moderna. You're looking at some of these companies that were very hot, were capturing a lot of excitement, whether you're Supermicro, where your underlying business has kind of had holes poked in it by a number of activist short sellers, or you're Moderna, where you had this big pull forward in vaccine sales, and now you're trying to find the path forward. The big question is, what are your fundamental buyers wanting, and how does the lack of exposure to passive or active money, just because you're being benchmarked potentially against the NASDAQ 100 or against the S&P 500. If you remove some of these companies, then you have to kind of reconfigure your portfolio. And when you look at some of the companies that get the boot, that's why you see a lot of these kind of plummeting lows.
And I'm glad you brought up Moderna, of course, a real sign of the times when it comes to that stock and just how things have changed so dramatically over the past 4 years. I also want to talk about Palantir, though, in this conversation about this big bid that comes into these names when they're added to these important indexes. Palantir switched specifically to NASDAQ to do this.
Exactly, and that's the whole kind of veiled tweets, whether or not they were kind of confirmed of a member of the management team saying that they were doing it to kind of go to where the attendees are. We do see retail investors flocking to the Qs, which tracks the NASDAQ 100, flocking to some of those levered ETFs that trade in these names. So there is not only kind of that retail play, which we've seen play out with Palantir going back to the meme stock craze, but really continuing to play out with the addition into the NASDAQ 100. And now you have, to your point, Sonali, earlier, you have another box that can be checked for would-be buyers, as well as kind of that passive money that is just going to be being pulled into some of these stocks.
Bailey, we thank you so very much for joining us this morning. A lot going on in the index world. That is Bailey Lipschultz. And coming up on Wednesday, don't miss it. We're going to speak with MicroStrategy Chairman Michael Saylor. That's at 10:30 a.m. Eastern on Wednesday morning. We also have some breaking news crossing the terminal. Canadian Finance Minister Chrystia Freeland announcing on X that she has resigned from her position in the cabinet. Certainly a lot of breaking news, a big moment over in Canada to see their finance minister therefore stepping down. We will bring you more from this breaking news as we get it, keeping an eye on the U.S. Canadian dollar on the move on the heels of that news as well. This is Bloomberg.
All right, welcome back to Bloomberg Open Interest. Let's take a look at futures right now. We are just minutes away from that opening bell, and we actually have green on the screen. Of course, you can see the S&P 500 up about 0.3%. We're coming off a weekly loss from last week, but there's plenty of catalysts coming up this week from the Fed, 2 earnings. You can see that optimism, too. If you take a look at the NASDAQ 100, up about 0.5% right now. The NASDAQ 100 and your big tech names have been leading this market over the past month. An interesting dynamic there. While we were all paying attention to the rotation trade, maybe it was falling apart. The Russell 2000, also worth a mention here, the small caps, they've been struggling as of late, but the Russell 2000 currently up about 0.1%. It just feels like we're all waiting for Wednesday, though.
You know, the Russell 2000, I've got to say, it's been interesting to see it plateau because you have to wonder how much more of a bid it'll get.
Yeah.
On the year, it's kind of equal to the S&P equal weight, but the S&P 400, for those who have been betting on it, is just a smidge ahead, just a little.
Pick your favorite index. There's a lot of dispersion in this market. Now, coming up, less than 4 minutes to go, we'll discuss the market moves at the opening bell with HSBC's Max Kettner. This is Bloomberg. All right, we are moments away from the start of trading on this Monday morning. This is Bloomberg Open Interest. I'm Katie Greifeld. It's the last week that matters, at least from a trading perspective of 2024. The final full week of trading that we have. And you can see we're starting on a green note, at least if you take a look at what futures are indicating. We had a bit of a downdraft last week when it comes to the S&P 500, when it comes to the Russell 2000. Of course, we'll see if we can turn around the narrative this week. We have the Fed, we have earnings, all of that and more coming up, of course, after what's been a really resplendent 2024, at least at the index level, if you take a look at some of these gains. But let's focus on today's action. Of course, in the first few seconds of trading, you see the S&P 500 higher by about 0.3% right now, fell by about 0.6% last week. So small moves overall as we inch towards the end of 2024. Big tech in charge right now. The NASDAQ 100 up about 0.5% right now. The Russell 2000, a bit of a wipeout last week, falling about 2.6%. Of course, yields were on the rise. That hurt the little guys. The Russell 2000 also feeling some pain this morning, down about 0.1%. Let's look under the hood, though. We're all about those NASDAQ 100 reshufflings, and we start with Supermicro, of course, among the stocks that's being removed from the NASDAQ 100 following the latest rebalancing announcement. You had shares up 28% as of Friday's close, but at least for right now, down about 11% pre-market. Illumina, Moderna also on the chopping block, and you can see investors deciding how to feel about it, Sonali.
Also looking at a few more names here, privy to the NASDAQ. MicroStrategy up more than 4% at the open, added to the NASDAQ 100 next Monday. But the rebalancing, of course, has been announced. MicroStrategy's inclusion may have bullish implications for Bitcoin itself, which continues to hit an all-time high. Palantir, though, down about 0.3%. In the inclusion, Axon, though, up another 1%. Flipping up the board, looking at a deal mover here. Honeywell says it's considering strategic options, including the possible separation of its aerospace business. Remember, last month, activist investor Elliott called for a breakup of its industrial group and one of its largest bets ever. We're going to get a deeper dive into Honeywell with Bloomberg's Abigail Doolittle.
Yeah, shares are performing really quite well, Sonali, up 1.6% this year, hitting a record high, up nearly 10% on the year after Elliott, as you mentioned, did take a $5 billion stake a little more than a month ago, wanting to break out value from the company. So the company now is saying that they are going to do a strategic review. They're considering breaking apart that aerospace business. Elliott has said that they're very pleased, not surprisingly, with the possibility of this plan. In addition, litigation has been largely settled for this company, removing that sort of a headwind. So again, the stock, this conglomerate that had been sleepy for a while, hitting an all-time high this year, up once again today. As for the competition, though, we're going to see that despite the fact that it is doing quite well on the year with a now 11% gain with today's gain higher, it's underperforming some of the other industrial companies, not quite as large, quite as big as the conglomerate of Honeywell. But nonetheless, this is probably the value, Katie, that Elliott is seeking to unlock in the strategic review. And again, the possibility of that aerospace split, well, investors liking it today.
Yeah, absolutely. Shares currently up about 1.3% when it comes to Honeywell. Abigail Doolittle, thank you. Let's broaden out this conversation now and bring in HSBC Chief Multi-Asset Strategist Max Kettner. Thrilled to have you back with us, Max. And I want to start with the rotation trade, or the lack thereof. It's interesting. This comes, of course, from our markets producer, Dan Curtis, who points out that the Mag 7 is leading the S&P 500 equal weight by the most on a monthly basis since May 2023, which I found a bit surprising. Is this just end of the year kind of funkiness, or do you think that this dynamic will extend into 2025?
No, probably a lot of it is a bit of end of year funkiness, like you call it. I think, look, overall, I don't think there's an awful lot of sort of post-election trade still going on, just like you said, right? We've got the Mag 7. This is not the sort of dynamic we should have expected if it was still a sort of post-election or if it was still about sort of the election expectations and what's going to come in terms of policy proposals. In fact, I think it has a lot more to do with tech still being pretty good, right? Like guidance of particularly some of the tech behemoths really starting to go up again, and that overall still benefits tech, I think, going into next year. You look at some of the numbers for next year, I still wouldn't really be betting against the Magnificent Seven. Some of the other sectors can catch up, so it's Magnificent Seven and the tech sector and the other stuff, but I don't think it's going to be, okay, we're going to have to buy all this other stuff instead of the Magnificent Seven. What I find remarkable, for example, is when you look at consensus earnings expectations for those 7 names, excluding NVIDIA, so for the remaining 6 ones, it's almost flat year over year for 2025 in terms of consensus earnings expectations. So it's not like we're going into next year and people are super bulled up on the tech sector and on these behemoths. It's really pretty subdued, and that opens the door again for pretty strong earnings surprises, I think.
It's interesting to hear you say this, because I'm looking through your notes, and one of the points you make is that the AI trade is fizzling out a little bit here. But at the same time, you're saying that you can't bet against the Magnificent Seven. So sort of thread those 2 points together for me.
Yeah, absolutely. I think, our outlook for next year still is one of absolute constructiveness. We're going into the first half, and frankly, I'm sort of, I'm sort of stopping at 15 positive catalysts because I'm running out of space on my research notes. But honestly, it's one after the other where we're going into next year. It's like, oh God, this is another one and another one. So we're really going into next year with a super constructive backdrop, whether that's from the policy side, whether that's, going from the earnings, from the consensus side, whether that's now upgrades to earnings expectations that could be coming into the next couple of months. Obviously we've seen some improvements also in small business and some consumer expectations and sentiment as well. On our measures, also actually sentiment and positioning is nowhere near stretched yet. It's still sort of neutral. Some of the indicators are stretched, but on aggregate, it's still actually pretty neutral. And to the AI trade that you were saying, one thing that we were mentioning where we could be going wrong, aside perhaps from really higher yields, lack of rate cuts and growth going so gangbusters, so in a way that we're too correct in our view going into next year, that really would make basically the market stop pricing any further rate cuts. That to me is still by far the biggest risk. But one other risk is that exactly that AI trade is fizzling out. Perhaps we'll start to see some of the those behemoths surprise to the downside. So look, I'm saying that is a risk. It's nowhere near our base case. Our base case really is the opposite. But we've got to acknowledge that, of course, when we look at, for example, the likes of NVIDIA, an NVIDIA earnings day nowadays is like a PMI, ISM, NFP day combined.
Right.
It's a macro event.
Yeah, certainly is. Speaking of NVIDIA, you're looking at 165% gain, and this Philadelphia Semiconductor Index is doing quite healthy, not that healthy, but quite healthy as well with the 23% gain. NASDAQ 100 up around 30%. If you think about the opportunity over the next 12 months for the best 12-month return, where is it going to be? Because even if you're bullish on all of these themes, you've seen quite a run up already, and you have investors scouring the globe for the next set of returns.
Yes, but let's all be honest that when we look at the earnings side, for example, so that's one of the things why we are relentlessly pushing back against this sort of bearish narrative that valuations are too stretched. Number one, valuations don't work on a short-term basis. So when you look at some of those names and people say they're too expensive, it's had this massive run-up, like you're saying, well, actually, when we look at the likes of NVIDIA, the PEs have barely changed over the last 2 years, simply because actually earnings have really been continuously delivering, and therefore we've not really seen valuations go through the roof. In fact, and you look at NVIDIA, free cash flow has gone up from what, 5 billion to more than 55 billion. So it's literally gone up 11 times over the last 2 years. So we're seeing such an incredible run up, not only on prices, but really on the underlying fundamentals. So to be honest, like we're going into the next year, I think, particularly the next 6 months, it's a bit of a story of more of the same. It's still tech. There are some other certain sectors, right? There could be stuff like perhaps even on the industrial side, things like perhaps on healthcare, playing the deregulation. I still really like the banks, particularly the large US banks, absolutely. But you won't be able to ignore tech. You won't be able to come around tech. You won't be able to really say, oh yeah, this is done. The Magnificent Seven, we're done with that run, and we've got to rotate entirely out of them. I don't think that's going to work because the fundamentals are so strong.
One of the risks you were talking about, and certainly a lot of investors are starting to bake in, is that kind of higher for longer narrative when it comes to the interest rate story. So what level of rates, how do you think about that number, the golden number at which you start to get worried? Because the market has shrugged off to a large degree the prospect of less rate cuts than expected.
Yeah, I think for the market, it's pretty binary. So for the equity market entirely, it's actually pretty binary, and so it is for spreads. As long as the Fed still keeps cutting, it's still good. So if we're still going to get, hey, 1 or 2 rate cuts, maybe spread out over 6 months, the market can take that, right? We've seen that time and time again in the last sort of year and a half. It's only the time when the market starts pricing in sort of a big wedge in terms of rate hikes. Now, what's the magic number right now? In our models, it's 4.5%. We've got this thing which we call the danger zone, which basically sort of models the level of longer term and medium term rate expectations and the level at which basically all asset classes would start to suffer. Not only the S&P, not only equities, but high yield spreads, emerging market spreads, high beta effects, literally all the asset classes. What we're seeing right now is that level is pretty much almost exactly 4.5%, just like we've seen that a month ago. Remember, a month ago, we had a tiny whiff of that already when we were sort of almost touching the 4.5%, and that was starting to put a bit of pressure on asset classes. Right now, if we're pushing sustainably above the 4.5%, I think that really would bring us a bit into trouble.
We're going to keep an eye on that 4.5% danger zone. HSBC Chief Multi-Asset Strategist Max Kettner, we thank you so much for joining us on what we really see, Katie, as the last week that matters. Now coming up, Dana Telsey joins the show with 15 consumer stocks to watch heading into the new year. It's all about 2025. This is Bloomberg.
All right, welcome back to Bloomberg Open Interest on this Monday morning. Of course, stocks have been open for nearly 15 minutes at this point, and you can see it's green, at least for right now, and at least if you take a look at the S&P 500, up about 0.2%. Of course, we did have a down week last week. We had that big rise in long-end yields that maybe put a dent in the S&P 500, maybe put a dent in the small caps, but the NASDAQ 100 has been where all your strength has been in those big tech names, and you can see that dynamic continuing today with the NASDAQ 100 up about 0.5%. And once again, you do have the small caps starting the week on a down note. The Russell 2000 unchanged, but I mean, the color is red, so I'm going to call that a bit of a downdraft as well, Sonali.
I'm also going to bring in some breaking news here. Of course, we have that PMI data coming in. We have December manufacturing PMI at 48.3 versus 49.7 prior. Therefore, you do see a weakening once again. You see services PMI at 58.5 versus 56.1 last month. Keep an eye on markets here, roughly flat because the trend line is the same. Manufacturing weaker, services stronger. We will keep an eye on these markets, of course, as we get more data coming in. Remember, tomorrow we also get November retail sales data, and we're going to bring this all together now. We're going to talk about the health of the consumer. We're going to talk about the health of retail. We're going to talk to Dana Telsey. She's Telsey Advisory Group CEO, and you have this economy that is telling you a few different things at the same time. We're getting into the end of earnings season. The companies are also giving you this insane bifurcation, if you will. Some of it seems to be a matter of not the macro, but rather of company management, of how companies are navigating the consumer at this part of the cycle, dealing with inflation that is a little bit higher than the Fed's target still. Dana, what do you think that into 2025 investors really need to know about whether the consumer will weaken materially or not?
I think overall, we're seeing the consumer being quite resilient, and you're seeing definitely the lower income consumer being very selective on what they're spending on essentials. You're seeing any discretionary spend is going towards items that are new, different, definitely more differentiated than something that they don't have in their closet on the apparel side. And we've seen a moderation in the pace of luxury spending. As you think to 2025, any continuation of lower interest rates would be a benefit for housing and for all of the home-related retailers. The tariffs are something that is a concern. It's expected that in apparel, if you put tariffs and requiring price increases that are nearly double digits, that would constrain some of the apparel sales, while the focus on value continues to remain front and center in 2025.
Well, Dana, let's talk a little bit more about management changes, because it has been a volatile year in the C-suite across industries, but also in retail. And in a recent note, you highlight 15 CEO changes that have occurred recently. And before we get into the specific companies and the different strategies that these new CEOs are sort of pursuing here, what does it say to you that there has been so much turbulence in the C-suite?
I think there has been extensive turbulence in big companies, small companies. I think the pace of change is accelerating. I think the fact that post-COVID, if you haven't improved your business model and you're not seeing an improvement in operating margins, there's got to be a change in what direction the company's going. And therefore, sometimes you're seeing companies bring back old people who had been at the company in order to reinvigorate it. You're seeing people come in from out of the industry to reinvigorate existing businesses, but staying the same, status quo doesn't cut it, because doing the same thing over and over again and expecting a different result is the definition of insanity. So newness, agility, and speed is what's required in order to take a business that has been stagnant and accelerate it. And it's accelerating in all different ways, whether it's marketing, whether it's product, whether it's expanding your customer, and using data to inform what could make a business transform.
Speaking of transformation, one of the big ones we're watching, of course, is Starbucks with a new CEO with a lot of hopes on him. You have this morning a report also saying that they have somebody now to lead their China business into kind of choppy waters, of course, into the country. You're still seeing Starbucks shares down year to date about 1.8%. How big of an issue is China for Starbucks? How important is it for Bryon Nickel to crack the code?
Very important. It's obviously they have a significant number of stores. Bryon Nickel's success at what he did at Chipotle, being able to overlay that with what he has in Starbucks, be able to take the installed base of associates and frankly transform them in order to build a winning culture will be key. And I think all the different regions need that acceleration to drive the transformation.
Let's also talk about Nike, which reports on the 19th. You think about sort of dramatic CEO changes. Obviously, Nike ranks up there. This will be Elliott Hill's first earnings call as CEO. You're taking a look at the year-to-date performance of Nike, down 28%. What will you be listening for?
I want to hear about what he's doing in order to improve the product. What I've heard is that he's brought back some of the old product designers in order to accelerate the innovation. He needs that core Nike brand to be new and different. Look what we heard, for example, on Foot Locker's call, where non-Nike branded product perform well. He needs to be at the center of the cultural conversation, and it's missing right now. How does he bring back that aura of a company who has such share and such resources available to them? I want to hear how he's going to instill that way to win and that swoosh that means something back in the conversation.
How to make Nike cool again? It is an urgent question. Dana, really great to preview it with you. That is Dana Telsey of the Telsey Advisory Group. Now, coming up, private lenders are trying to attract retail investors. We'll discuss next in our Wall Street Beat. This is Bloomberg.
And it's time now for the Wall Street Beat. We're going to take a closer look at how Wall Street is trying to refuel the private credit boom. Direct lenders are hoping retail investor strategies can increase growth because investments from asset managers, pension funds, large institutional investors have flatlined. Here for more, we are joined by Bloomberg's Denitsa Seikova, who has been reporting on Wall Street's big Main Street push. You think about the returns you can get in some of these interval funds. You were talking about one woman that is getting a 37% return over 2 years, wanting to access more. Do these last? I mean, ultimately, do retail investors believe that they can get above average returns over the longer term by shifting some of their allocations over?
For sure. So in the last 2 years, it's been obviously a very lucrative investment, and all the retail traders we spoke to are quite happy with the returns. It's been a good time. Also, a lot of the retail investors we spoke to, they're investing in all those big names. They have Carlyle, they have Blackstone, which potentially have much longer history and less issues with redemptions, even though some of those firms do have issues. But now what we're seeing is amazing proliferation, and we're talking specifically about interval funds, and so many big and small names are entering the space. And what we're seeing is that with any proliferation, products come with different quality, different minimums. The thing about interval funds is you can lock up investors for significant time. So you can imagine we've seen some funds lock up investors for 7 years.
Oh, wow.
A lot of the big names, it's much lower. People can redeem their shares every quarter. So it's a lot more accessible. Well, we've seen some extremes in terms of how long those products are holding investors.
And so we only have about a minute left with you, but I am curious what the pitch is, because of course you highlight a woman, like Sonali said, 37% return over 2 years, but you could get that or better in the public markets just by investing in the S&P 500.
For sure. I think the pitch is we're diversifying, we're giving you access to something only institutional and ultra wealthy individuals have access to, which I think is quite attractive to retail investors. That one thing that comes with the pitch is actually the fees are pretty high. And at least from the conversations, I'm not sure everyone's aware how high the fees are. Like the average fee is around 2.6%. And then a lot of those products work with incentive fees. So after you reach a certain threshold, you have like a 20% incentive fees. So if you had a great year, that's great, obviously, but then there are extra fees and extra fees. So it can be quite pricey.
Plus, you have to find out where you're going to actually buy this stuff.
True.
And, Apollo, Blackstone, they're trying to make this available for infrastructure, for private equity. Let's see if they could be as successful in those other products.
Got to get it on the apps. Denitsa, fantastic reporting. As always, appreciate you taking the time. That is Bloomberg's Denitsa Seikova. And coming up in the next hour, Bryon Leagh from Goldman joins us at the desk, and then we'll speak to Bill Dudley about the Fed, as well as Coupa's CEO joining us in the C-suite. This is Bloomberg. All right, we are 30 minutes into the trading day on this Monday morning. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
I'm Sonali Basak, and Matt Miller is off today. And coming up, it's a big week ahead for central banks. We're going to get a flurry of data and decisions with the Federal Reserve leading the way. And Goldman expects the Fed to signal a slower pace of easing and to skip cutting rates in January. Former New York Fed President Bill Dudley is going to weigh in. Plus, political turmoil in Germany. We're going to be live in Berlin as Chancellor Olaf Scholz faces a vote of no confidence today, Katie.
All right, all of that and more coming up. But let's get a check on these markets right now. It is the last week that matters. I will say that over and over again. And at least we have some green on the screen. The S&P 500 up about 0.3%. Big tech breaking away right now. The Nasdaq 100 up about 0.9%. This has been your outperformer for a few weeks, and obviously that dynamic continuing today. The bond market relatively well behaved. You can see the 10-year yield down about 1 basis points. We were higher by 24 basis points on your 10-year Treasury yield last week. We'll see if that volatility continues. But let's broaden out this conversation, because joining us now at the desk, I am thrilled to say we have Bryon Leagh. He is Goldman Sachs Asset Management Chief Transformation Officer for the Client Solutions Group. Bryon, it's great to see you.
It's wonderful to be back. Thanks for having me.
So you joined GSAM from JP Morgan. You started officially in July. This is your first television interview at GSAM, so appreciate you doing it with us. I've asked you this question a few times, but now we have cameras in front of us. What does a Chief Transformation Officer do?
Yeah, well, Katie, thanks for the question. I mean, we're so excited about the entire asset management industry going forward. I don't think there's ever been a better time to be an investor. The selection, the availability, the different technology that asset managers are working on delivering for investors is really profound, and it's only accelerating. And so my role as Chief Transformation Officer is to work with the other leadership and the rest of the team across Goldman to make sure that we're well positioned to deliver those capabilities to investors. Now, most people are surprised to hear from me that Goldman is actually the 8th largest asset manager globally. We're top 5 in public active assets. We're top 5 in private assets. So we have all these great component parts to deliver solutions to investors.
A few days ago, we spoke to your colleague, Mark Nachman. We asked what he wants to do. Tall order here to become #1, especially when it comes to the active ETF business. You were very senior at JP Morgan in that business. So how do you bring that love over? What is the plan for Goldman to bring you further into that space?
Yeah, crucially, as we've talked about before, the ETF is a technology. That's the delivery mechanism. The parallel that I always like to talk about is the MP3 or digital streaming music. That's the way you consume the music. What you put inside the ETF is the investment engine, the investment content. And at Goldman, we have incredible active capabilities. We've launched 7 active ETFs over the last 12 months. We've got 4 active muni ETFs that we launched just recently. And that's the type of differentiation that Goldman can bring to the active ETF space. We have strong plans to continue to build out that space. And so we're going to make sure that we take the best investment capabilities of Goldman Sachs and deliver them through the ETF technology.
And when it comes to the ETF world, and we will broaden out, but something that's been amazing is the derivatives products, just the number of derivatives ETFs that have come through, inspired in part by JEPI, of course, but that's a JP Morgan product. But talk to me about that, because it kind of feels like we're entering into Frankenstein territory with some of these funds. I'm curious for your take.
Well, I mean, look, we're always looking for innovation, and I think the key in this industry is not to over-innovate, to come up with something too crazy that investors don't know how to put it in their portfolio. What I know is investors are always looking for income. And so, you know, at Goldman, we have GPIC and GPICs, the premium income strategies. The performance there has been excellent. They're differentiated from what's already on the market. We've also delivered things like our small cap capabilities, where we're moving down towards small cap names and delivering those in the transparent ETF wrapper as well. So I think that's one of the things I love about this industry is this continued innovation, looking for ways to help investors achieve their investment goals and delivering that through the different wrapper that maybe is the most appropriate for the different asset classes that we're building.
Speaking of wrappers, Katie and I talk about this a lot. All of Wall Street has been rallying around this idea of how to make private assets more available to more investors, particularly retail investors that have traditionally bought ETFs, invested in public markets. But when you think about the way they are offered, they're currently semi-liquid in a lot of ways. How is Goldman really attacking this phenomenon? Are you trying to get more product out there for retail investors?
I mean, Sonali, if you look at it on the institutional side, they have almost 20% of their portfolio invested in alternative assets. When you take that to the more retail or the wealth end of the spectrum, it goes below 5%. So to your point, there's a big discrepancy between what investors are getting on kind of the retail side from an alternatives perspective. And we know alternatives can help outcomes. It can improve performance, it can enhance yield, it can increase diversification, it can help you manage risk. These are all the benefits of bringing alternatives into the portfolio. And so I think the industry is seeking the ability to find good alternative capabilities and then match that with the wrapper of choice where investors can consume those in a seamless way within their portfolio. So interval funds is a great idea, SMAs. I think what we're going to see is a spectrum of capabilities that match this to what portfolios are trying to do. Now, one of the things that we're thinking about is what we call the total portfolio solution, or you sometimes hear UMA. So this is the ability to bring all of these things into one giant picture, whether that's ETFs, individual securities, separately managed accounts, or indeed alternatives, and the ability to deliver all of that so that an investor can have a total portfolio, a total customized portfolio to deliver the outcome that they're looking for. That's where I think we're at, and we're right on the cutting edge there. We've partnered with GeoWealth, which is a technology platform that helps deliver that customization, personalization of portfolios at scale for RIAs and individuals. And I think as we watch over the next coming years, that's going to be the area of continued innovation.
So, Bryon, you know better than most in this industry, though, that you can have great strategies, great capabilities, great products. You can build it, though, and maybe they don't come. So are you investing more heavily to reach some of those potential investors? Are you investing more in marketing, for example?
Well, we're really excited about the way that we're positioned in the market right now. We've got a distribution force, we've got the marketing capabilities, and critically, it always comes back to that content. I mean, thinking about the music analogy earlier, great songs find their way onto our phones, right? So that we can listen to those. And so if you get that content piece right, the rest is really going to pull through. But we're doing everything in our power to make sure that investors are aware of what we have so that they can use it in their portfolios.
Now, I also want to talk about where we stand. You think about interest rates. I was looking at the 10-year with Katie a little earlier. The fact that we're by 440 still is just breathtaking going into the end of the year. And the reason I bring this up is because another big theme we talk about a lot is how much money has been sitting on the sidelines in money market funds. Goldman has a massive money market business. And if you have to tell your clients, okay, well, maybe take some of your chips off that table, are they doing it at this point? Why would they?
I think there's slowly going to be a trickle, and then it's going to move very quickly. I think as everybody wakes up and sees that their yields have changed, and that as they look at the opportunities that are presented in the fixed income space, you can get that enhanced yield without taking on a ton of duration risk with that. And so I think we're having a lot of conversations about investors getting ready to make that move. And so that's definitely going to be a step that we see people coming out of money markets and into something that gives them a little bit more yield. I think there's also a tremendous amount of FOMO, given that that cash has been on the sidelines and these markets have been fantastic. And so where are investors looking to do that kind of, I don't want to call it a catch-up trade, but start to deploy that money into markets. And again, I come back to things like small cap. I come back to things like GPIC and GPICs, which are capabilities that would give investors equity-like performance with income, but can also protect a little bit to the downside if investors think that these markets have run a little bit on them.
Yeah, getting investors out of cash, it seems like that is the question that every asset manager is trying to answer right now. We have less than a minute left with you, never enough time, but you've been in the seat since July, as we discussed. What is the priority for 2025, both for you and for GSAM?
Yeah, they're one and the same, right? Because we wake up thinking about investors and we wake up thinking about what they're trying to do in their portfolios. It's the conversation that we just had right here. We want to think about how do we thoughtfully deliver our alternative capabilities, our leading private credit capabilities, private equity, infra, real estate, and make those available to investors in the wrapper that they want to consume that in, number one. Number two, customization. We're thinking about separately managed accounts. We're a leader, number one in SMAs in the US. We also have a great direct indexing capability where investors are obviously, we didn't talk about taxes today, but investors are always thinking about taxes. And then active ETFs. Those are the three areas where we feel like we've got differentiated investment capabilities. We're delivering them through the wrapper that investors want to consume them in their portfolio. And then we're being thoughtful about how we can deliver that to the market. So that's where we're focused.
Bryon, congrats on the first few months of your new role. That is Bryon Lake of Goldman Sachs Asset Management. Now, coming up, we're going to shift over to talk about what's going on with the Federal Reserve with former New York Fed President Bill Dudley. He's going to bring us his expectations for this week's Fed decision and that dot plot, of course, ahead. This is Bloomberg. The latest Fed rate decision is out Wednesday, and most economists anticipating a quarter-point rate cut. Recent comments by Fed officials, however, have suggested that some may be on the fence. Joining us now for his take is former New York Fed president and Bloomberg opinion columnist Bill Dudley. And Bill, you look at, for example, let's just take Goldman Sachs for a minute here, where they see a cut, just as the market does in December, and just as the market does, they see them skipping in January. The bigger question that I have, though, is what if they keep skipping beyond January? How do you think the story starts to play out into 2025?
I think the expectation is that they will continue to do rate cuts in 2025. And I think the dot plot will show 2 or 3 rate cuts in 2025. But to your question, what would cause them to not just pause, but to stop? That'd be an economy that continues to do better than expected, inflation that's sticky, and the Fed revising up their estimate of what a neutral interest rate is. The Fed's been very slow to raise the level of interest rate that they think is consistent with neutral. Last summary of economic projections, they were at 2.9. Most people think that that median estimate will drift up to 3.0 or 3.1. But if you look at market estimates, they're much higher. The market thinks that the Fed funds rate is going to bottom out around 3.75%. So there's a pretty big gap between where the Fed thinks neutral is and where the market thinks neutral is at this point.
Yeah, fighting the Fed, of course, is alive and well, at least when it comes to the neutral rate and where we end up. But I am curious. I mean, at least according to reporting from the Wall Street Journal out over the past couple days, there is some reassurance needed that Jerome Powell has had to give to some members that are worried about sticky inflation, like you say. Do you see evidence that inflation maybe is a little bit stuck here?
Well, it's a little bit stuck, but I think Powell's interpretation is it's stuck for reasons that are going to turn out to be temporary rather than more persistent. Shelter cost inflation is expected to move downward just over time. There's a lot of inflation pressure from things that are lagging, like insurance cost. So Powell's view is that he's pretty optimistic about the outcome. But yes, you're absolutely right. We could get stuck at 2.5%. I think that what's going to be interesting about that next week's meeting as well, this coming week's meeting as well, is how rosy the Fed's forecast is going to be. It's going to be a soft landing forecast. We go to 2% inflation. The Fed cuts rates in 2025 and 2026. The economy is going to be growing, 2% plus. There won't be anything yet about what Trump is going to do in terms of tariffs and deportations. Just the only assumption I think the Fed's going to make on Trump is that the tax cuts that were due to expire at the end of 2025 are renewed, are sustained.
How much control, Bill, does the Fed really have over the long end? And how much does it create an issue? Because if you think about it, you have a 10-year now hanging out just under 4.4%. And if you have to worry about things like mortgage rates, which are perhaps far more anchored to those longer-term interest rates, then don't you have an inflation problem no matter what? Because you have that stickiness in shelter, among other things. If the Fed can't control the long end, then how much is there a problem in controlling where the direction of inflation goes and the shorter term expectations too?
Well, I think the bond yields reflect two things. Number one, what's the path of short-term rates going to be in the future? And the market has a view that the path is going to be quite a bit higher than what the Fed says. And two, there's a risk premium. So I'm holding a long duration asset. I have more risk. And so how much do I have to be compensated for that? Post the great financial crisis, the risk premium for bonds was essentially zero. People looked at bonds as a hedge against a very bad economic outturn in terms of economic growth. Now, though, I think people are more worried about the fiscal side, that we're on an unsustainable path. And so people are demanding a bit of a positive risk premium to hold bonds. I think where the bond market is today is completely reasonable.
Completely reasonable. I do want to draw out that point a little bit more, though. Like you said, there are those concerns about fiscal, so maybe the long end is responding to that. I mean, are bonds losing a bit of their haven appeal, though, against that backdrop?
Well, I think what's changed is that the Fed now is at a level of short-term interest rate that there's plenty of room to cut rates and stimulate the economy. So people's worries, like we had following the great financial crisis, that the Fed could cut to zero and then be pinned there, and not be able to do anything to get the economy out of the ditch. It's sort of a Japanese-style situation. I think that fear has lessened a lot. And obviously, the sticky inflation weighs on the other side. If inflation is going to be higher for longer, that's got to be incorporated in bond yields.
You know, we've been talking so much about the long end, and when it comes to the short end, I do have another question, because issuance has been a massive question mark this year. And of course, as we head into next year, in addition to those policies put forward by the president-elect, you will have a new Treasury Secretary that will have to contend with that issuance schedule in the wake of the current debt load that we are sitting under. Do you think that he could be successful in terming out that debt? And if not, then what does it mean for how the market can absorb things in the shorter term?
Well, my own view is that the Treasury will probably end up doing what they've always done, which is emphasize being regular and predictable, so the market doesn't get surprised by their decisions. I think that, they obviously the debt limit ceiling could complicate things quite a bit in the first half of the year if it's not raised in a timely way. If that happens, the Treasury cash balance will be run down, and then once the debt limit's solved, they'll have to build it back up. So that could influence the decisions. Steve Mnuchin, when he was Treasury Secretary, he wanted to do a super long bond, super long Treasury bond, and eventually he decided that wasn't such a good idea after all. I think Basak will probably not change the maturity distribution of the Treasury market very much because it's disruptive and it creates uncertainty, and you then have to compensate investors for that.
All right, Bill, we have to leave it there. It's a real treat to speak with you, of course, 2 days away from the final Fed meeting of the year. Our thanks to former New York Fed President Bill Dudley. Now, still ahead, German Chancellor Olaf Scholz facing a vote right now as the country moves closer to a snap election. We'll head to Berlin next. This is Bloomberg.
Now, German Chancellor Olaf Scholz's vote of confidence is now underway, and he has every intention of losing, which would trigger a snap election in February. Joining us now from Berlin, Bloomberg's Oliver Crook. How big of a political gamble is this?
Yeah, well, listen, it's one that has been, unfortunately for Olaf Scholz, basically forced by the fact that on November the 6th, actually hours after Trump was elected president of the United States, which was already a blow to the German political establishment and the mainstream politicians here, basically he fired the finance minister because they just could not agree on getting a budget over the line. Does that sound familiar? It's more or less exactly what's been going on in France, because all of these economies in Europe, these big central economies with 0% growth, it becomes very difficult to allocate this kind of money, and it's really causing major problems within the economy. So we're expecting the result of the vote really actually any minute now. There have been 2 hours of debates. Olaf Scholz was before the parliament, gave a 25-minute speech. And really for everybody, this was an opportunity to do a bit of grandstanding, to do a bit of campaigning. And really by German election standards, this has been a pretty intense, pretty vicious election campaign where you have, Friedrich Merz, the leader of the CDU, Merkel's traditional party, saying that basically Scholz is a failed chancellor. Scholz, for his part, saying that there needs to be more spending, accusing the FDP, which is the finance minister that he fired, of basically not being morally fit to govern. And then you have the far right, the AfD, the Alternative for Deutschland, that now has about 20% of the vote, basically saying that Germany is on the brink of collapse and that a vote for Friedrich Merz at the CDU is basically a direct declaration of war on Russia. So that just gives you some of the color of the conversations that have been happening in the Bundestag today as we await imminently for that no confidence vote result, in which we are expecting Olaf Scholz to not win the confidence and basically then call that election for February the 23rd.
Well, the big take today, Ollie, is Germany's economy is unraveling just when Europe needs it most. So give us some context here, of course, situate this conversation in the economic backdrop, what that means for Germany and also what this means for Europe.
Yeah, so listen, I think that this is basically an election that was forced by the economy. Again, there was this sort of zero growth situation in Germany where you don't have the budgetary freedom. Of course, the Germans also have this constitutional debt break. That's something that Angela Merkel brought in. It's literally part of the Constitution. It takes 2/3 of the government to change this debt break, which basically prohibits the government from borrowing in excess of 0.35% of GDP. And this is what Olaf Scholz and the Green Party, for example, these are people who want to reform the debt break. They say it's like boxing with your hands tied behind your backs, and your adversaries you're boxing against are China and the United States, and that basically Germany's unwillingness to do any sort of debt finance, to do any sort of the investments that this economy desperately needs, is something that's really holding them back. And when you think about what's happened in Germany, because we've seen the PMI charts, 2.5 years of manufacturing contraction, that's one thing. It's where the rubber hits the road, and that's this year. We're talking about 60,000 job cuts in major German companies across the sectors this year alone. We have Volkswagen right now negotiating with management for job cuts that could be 10,000, 20,000, 30,000 additional job cuts. And Volkswagen, a company in Germany that's about 90 years old, has never once closed a factory in Germany. Is talking about closing 3 of them right now.
Wow, yeah, real sign of the times there. Appreciate your on-the-ground reporting. That is Bloomberg's Oliver Crook joining us from Berlin, where that no confidence vote is underway. But let's bring it back to the U.S. Let's bring it back to these markets right now. The S&P 500 higher by about 0.3%. Big tech running away with it. The Nasdaq 100 higher by about 0.9%. The 10-year Treasury yield, I'm going to go ahead and call it unchanged. Of course, we are just below 440. We had a big week last week, now taking a little bit of a breather. Now, coming up, Coupa is out to transform the financial services industry. We'll speak to Leagh Turner. She is the company's CEO next. This is Bloomberg.
Coupa, backed by Thoma Bravo, has been racking up C-suite clients, and the company uses AI to help eliminate billions in expenses. Its technology is used by over half of the Fortune 500, including Microsoft, Reddit, and Uber. Joining us now, Leagh Turner, Coupa's CEO. When you think about the promise of AI, a lot of people are thinking about it in terms of what you're seeing in the hyperscalers and the data centers. We're trying to find more and more out about the way companies can use it. You've been helping your clients save billions of dollars in expenses, double-digit billions of dollars in the quarters alone. How does this actually work at the end of the day, and what are companies finding that they wouldn't have been able to otherwise?
Yeah, that's an amazing question. So this is becoming a catchphrase, but the absolute best AI is based on the best data. Here's the really cool thing about Coupa. For 17 years, this is the brilliance of our founders, we have been with our customers' permission, that's buyers and suppliers, capturing data. We structure it, we clean it, we anonymize it, and we surface it in our application. And as a result, we can apply AI and in future federated AI agents to be able to take out work. So this isn't evolution of business processes. This is revolution of business processes. So in a world of global trade that's growing at about 14.5% CAGR and will crest $33 billion this year, you can imagine the amount of cost that we think about taking out of the matching of buyers and suppliers by leveraging AI.
What are your clients finding in terms of the strangest thing? Maybe it's something they didn't know before that your software has helped them find in terms of the way that their expenses are panning out. Is there a specific line item, especially in the last year or so, that has ballooned to the point that they didn't realize it had gotten to the point that it had?
Yeah, I mean, let's think about what happens in our data, okay? So inside our data store today are contracts, sales orders, purchase orders, delivery notices, goods receipts. And you can imagine that this is the way that our customers think. I'll give you a perfect example. I was having a conversation with the CFO of UPS, and he said, why, if you know all of those things, do we need to employ teams who process invoices? Because the reality is, you know when the transaction is complete. You can execute that transaction on our behalf and take out cost. And that's true. That's a great example. In the future, what we imagine is this giant data store. Today, it's $7 trillion of transactional data. It grows by about $1 trillion a year. And if you deploy a federated force of agents against that data, you can match, verify, execute, and pay a transaction without any human intervention. And to the buyer, that is about $100 billion a year in cost savings. And to the suppliers, it's about $250 billion in cost savings. So you can imagine, we see a future where trade executes autonomously and where $350 billion a year goes back into the economy in the form of innovation and ingenuity and the application of humans to higher order work.
And we do want to bring you some breaking news. Of course, we were just in Berlin talking about that no confidence vote. The headline now that the German parliament clears the way for an early election in February, a snap election, of course, following that no confidence vote. We will continue to follow that story and bring you details as we have them. Euro USD, that currency pair, just about flat on the news. We'll continue to monitor that. But Leagh, we were just talking about the future with you, of course, of Coupa and where you see basically your industry evolving. But I do want to look back a little bit. You mentioned, of course, that Coupa was founded 17 years ago. And I'm curious when Coupa went really heavily in on AI. It's only been in our conversations for about 2 years. But how long has Coupa been working with this?
Yeah, the answer is forever, because AI has really been an evolution, as you know. This isn't like revolutionary technology. It's been in play for a very long time. Used to be called data, insights, analysis, analytics, and then it evolved. And so we've been using AI. In this quarter alone, we have derived $3 billion in benefits for our customers. For all of the 17 years, and increasingly so over the course of the last decade. And today we're a Rule of 50 company trading in the private market with revenues north of $1 billion. You know, our primary shareholder is Thoma Bravo. Just an excellent, excellent sponsor, gives us tremendous latitude to be able to leverage the best technology and to be able to make the most of this incumbency advantage, this data store that in the age of AI cannot be breached.
Leagh, I want to bring, you mentioned Thoma Bravo. Thoma Bravo completed the acquisition of Coupa in early 2023. Of course, Coupa was prior public company as well. What do you think the future is for Coupa? Do you think you'd make it back into public hands after being held in private for the last couple of years? And what would be the rationale for that?
Yeah, it's a great question. I'll tell you, an IPO may be part of our journey, but it is certainly not our destination. If the business is ready and the market conditions are such that, you know, they're favorable, and the opportunity presents itself, might that be something that occurs? Yes, but this team, and we employ about 3,500 people globally, are completely focused on building a generational company that changes the world, that makes for more responsible trade, that makes for more resilient supply chains, that increases decision making, that creates autonomousness in the way that buyers and sellers engage, reduces risk, and that, as I said, allows people to do higher order work. That's what we care about. That's why we come to work every day.
So they completed the acquisition, Thoma Bravo, of Coupa in February 2023. You were brought on or announced in November of that year. Since you came on board, what do you think the biggest turnaround has been of what you've done with Coupa?
Just complete unity of vision. Again, having a data store of this size at this time is an incumbent advantage. It's actually the first time in enterprise technology, in the history of enterprise technology, that the incumbents with data have a remarkable advantage. Because in the future, enterprise technology will be nothing more complicated than really big, clean, structured data stores and ways of engaging with that data. That's it. That's all that will exist. And so we've been really focused on ensuring that that data is trusted and safe, ensuring that we get the most of it, and ensuring that we apply forward-thinking AI in the form of federated agents against that data to be able to take work, manual intervention out of people's day-to-day.
All right, Leagh, got to leave it there. Really appreciate you spending some time with us. That is Leagh Turner. She is the CEO of Coupa. Meanwhile, we do want to bring you back to that breaking news from Berlin, and that is that the German parliament has cleared the way for an early election in February. That, of course, means that German Chancellor Scholz has lost the confidence vote, but we know that that's what he was trying to do, basically end his embattled administration. Taking a look at our reporting right now, this maneuver sets the stage for an election on February 23rd that is 7 months earlier than scheduled. Not a lot of market reaction, at least when it comes to the currency pairs. So let's turn back to these U.S. markets and get a check on what's going on. We'll do that with Abigail Doolittle.
Well, Katie, let's take a look at the S&P 500. Right now at session highs, but this comes after a down week. So you can see the intraday volatility and the daily volatility that we've had more recently. But again, right now, this index trying to break out of the malaise, up about 0.4% after falling about 0.6% last week, the worst week in a month. Sometimes you see this kind of choppiness around trend changes, a bit of a bull-bear battle. So let's stay tuned to that. As for that down week, we have mixed weeks for stocks over the last 2 weeks, which is pretty interesting because that also supports the idea of some sort of a trend change possibility. You can see last week in purple, the Russell 2000 down in a big way. The NASDAQ 100, however, up both weeks. The Dow up 1 week, down another week. The S&P 500, same deal, down as well. So investors trying to sort this out. Typically, December would be a month that would be good for small caps, especially given President-elect Trump and the expectation that his administration will be positive for these more domestically based companies. Not right now, though. So this is really interesting to watch. On this week, though, the week super young, we have the indexes higher. And then finally, beneath the surface of today's S&P 500 gain, we do have Merrill Holdings up about 8.6%. Bitcoin keeps going. MicroStrategy being added to the NASDAQ 100. Providing a lift for the whole space. Broadcom, after having a record week last week since going public back in 2009, up about 25% or so on a strong outlook around AI. Bernstein today naming it as a top chip pick. Ford, on the other hand, down 3.5%. Jefferies has cut to an underperform from a hold, saying that there's a lot of uncertainties there, including inventory overhang, and some issues in Europe. And then finally, Super Microcomputer, the opposite of MicroStrategy, being taken out of the NASDAQ 100, those shares down 6.2%.
Abby, we thank you so very much for keeping an eye under all things moving under the hood. Now coming up, a story about wealth inheritance. Ellevest head of private wealth management, Emily Green, is discussing how women are benefiting. This is Bloomberg.
Well, it's time now for our daily Wall Street Week conversation. And according to research, Americans will inherit more than $100 trillion over the next 25 years. David Weston spoke with Ellevest head of private wealth management, Emily Green, about inheriting wealth and how women stand to benefit the most from it.
Enormous amounts of this are going to women because first you have to think that men and women have different life expectancies. So first the money goes to the wife within here, and then it goes to women. And what people forget about this, because you're like, oh, the population's 50-50 within there, that this next generation, millennials and such, there's a lot more single women there have been in prior generations. So there's a lot more women controlling the wealth as this inheritance comes down than there was previously. You look at even in the next few years, so it looks by 2030, you're looking at enormous amounts even within this. And we've already seen this been happening. Like these numbers are already occurring. We did a survey at Ellevest, and it was interesting because we interviewed men and women. And it was about 17% of men thought that women would be the ones who got the most money out of this, and 45% of women thought so. And then when you, 43, 45, and then when you look at it, you interviewed women and asked them, are you expecting to get an inheritance? And actually over 40% of women said they were expecting to get an inheritance. So when you look at these numbers, there's a lot of women within there thinking about this. And so I think we just think about money and we think about that it's going to go to the men, but it's really going to change the way that we invest, spend, give, all these different types of things because women are going to get this huge amount of money.
How far along are we in the process of this wealth transfer?
We're still really early. We look at, like the first chunk is thought to be really in the next 6 years by 2030, but you're still looking at, 2/3 of that they've estimated comes after that within here. And so this has really just begun.
Is there a difference in your experience in the way men invest versus women, or older generations invest versus younger?
Yeah, so I worked at a traditional bank for a long time, and then I've started our private wealth business at Ellevest 7 years ago, and there are definitely some differences within here. And so I think men versus women, and what we found is that women tend to think about their goals versus like, do I want to buy this stock versus that stock? And so I want to buy a house. I want to leave an inheritance. I want to make sure I have a legacy. I want to give philanthropically X amount of dollars a year. They think more in terms of like tangible things to them than just like, I want to buy NVIDIA stock. It's really interesting because in volatile times, we've actually found that women actually have tended to have a steadier hand. So I worked at a big bank in the 2016 election. And I remember waking up that morning and like running to work because thinking like the stock market is down. By the time I got there, it was up. But I had a million clients calling me, and I work in New York. There's a lot of men, male clients, saying like, I need to pull my money out. Like the stock market's going to crash.
And that was Emily Green of Ellevest. And David Weston joins us now. David, a fascinating conversation. I find this trend so interesting. Talk us through some of the implications that, of course, it sounds like women are going to be coming into a lot more money, a lot of that inheritance coming through to women. What does that mean from an investing standpoint, and how is Ellevest going to meet that?
Well, one thing you just heard there, I bet didn't surprise either of you, that men are a little more panicked when things turn down. Women have a little steadier hand, you know, they sort of keep their hand on the tiller. There's also, she says, somewhat more concern with social consequences of investing, that women have a tendency, on average over time, to do that. Another big change is coming is in her business, because there's going to be all this money coming to private wealth. And as she said, a lot of the private wealth advisors are plus 50 men, white men, and increasingly women are going to come into her business because women would like to work with other women, and that's really going to shift things.
There's going to be a lot of change with this intergenerational wealth transfer. And if you think about the broader implications, what else has to change?
Well, one of the things that I found fascinating, Larry Summers co-authored a paper on this subject in 1981, when he was still studying for his PhD, talking about how much of the money is being inherited rather than earned. The big difference is we think that we build up our capital over the course of our lifetime, our professional lives, and in fact, increasingly people are inheriting. So how you end up socioeconomically is largely determined for a lot of Americans by who their parents were rather than anything else. And of course, this leads to dynasties. It really concentrates capital, which has implications for how capital is allocated in the system.
Well, also, I mean, we're kind of there, but talk to us about inheritance taxes, because that's a very real thing as well.
We talked to Larry about that very subject, because he said this really does raise questions about inheritance tax. As we know, under President Trump, they cut the inheritance tax. Now he, on the campaign stump, said that he wants to eliminate it altogether. So that has real ramifications, something that Larry doesn't particularly agree with. But one of the interesting things was, I said to Larry, be personal now. You wrote that paper in '81 when you didn't have children, you didn't have grandchildren, you weren't even married. Now you have a granddaughter. Has your attitude changed to say, well, yeah, it is a little bit different? And I really do respect the inclinations of parents and grandparents to be able to pass on wealth to a generation. He's a little more sympathetic than he was.
Yeah, well, a fascinating conversation. Really excited to watch it in full, of course, on Wall Street Week. That is David Weston. You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. Well, history will be kinder to Joe Biden than the pollsters. That's the latest take from Bloomberg's editor-in-chief emeritus, Matt Winkler. In a Bloomberg Opinion article, Matt writes that the 46th president laid the groundwork for U.S. exceptionalism lasting many years, perhaps even decades, after his administration has long ended. I'm pleased to say that Matt Winkler joins us now to talk about Biden's legacy. And timeline matters in everything, but especially in this conversation, Matt. So talk us through the argument about why it seems like it'll take a little bit of time to season for Biden's legacy.
So one has to go back really to Lyndon Johnson to find a comparable legislative record of achievement with Biden. And if you think about his past 3.5 years, 4 years, the legislation that came out of Washington was unprecedented in the 21st century. And as I said, you'd have to go back 50 years. And what did it do? It changed the trajectory of the economy in the following ways. We went from being a nation that was losing its manufacturing base every single decade since the 80s, and for the first time, manufacturing was coming back to the U.S. It substantially increased the well-being of Americans. By that, we look at the poverty rate collapsed, the uninsured rate fell to a record. Americans had more savings than they ever had in the 21st century, and unemployment was the lowest since I got my first job as a newspaper delivery boy at the age of 11 in the 1960s. So these are really big things, and all of them continue. It just takes a bit of time for people to appreciate what this legislative achievement is. It doesn't happen overnight. And it's very similar, by the way. Lyndon Johnson created what we call the Great Society. People didn't see it right away. They didn't see it in 69 or 70. But by the late 70s, the Great Society really was a part of American life.
And a side note, I love knowing that you deliver newspapers as a first job. So did I, Matt. One piece of data in your column that I want to point out is that investors are now paying a record 28% average premium to own American stocks, which was more than twice what they paid under Trump. And now that you're seeing Trump 2.0, you had made the point also that the gains that have been enjoyed right now will last for decades. But is some of that going to be compromised given the differential you've seen under the two presidents?
Well, if Trump likes the stock market as much as he does, he's probably not going to have an incentive to see it deteriorate. And so one plausible scenario is that he inherits, what Biden started, and he and his party actually don't dismantle it. Now, that's not what their rhetoric says. But for example, Georgia is now a manufacturing hub because of EVs and batteries and so on. And Arizona semiconductors are booming because of Biden. So it's possible that the prevailing government that Trump has will not do much to destroy it. And one of the things that he's always talking about is the stock market. So if the stock market suddenly starts to deteriorate, that's not going to be good for him.
Right. So we're up against a hard break, but with the 30 seconds we have left with you, we've touched on some of this, but when legacy reflects back on Joe Biden, what do you think the signature pieces of legislation will be?
Well, he made the United States economy second to none in the developed world. It has performed better than it ever has, actually, in our lifetime against the rest of the world. I mean, you'd have to go back to post-World War II America to find something comparable, and that's, before our lifetime. So this is the most significant thing, that relative to the rest of the world, the U.S. is the strongest it's ever been.
All right, Matt, got to leave it there. Really appreciate you taking the time to talk about this piece. You, of course, can find it on the Bloomberg terminal on Bloomberg.com. That is our editor-in-chief, Emeritus, Matt Winkler. Now, coming up on Open Interest tomorrow, we have Kristen Roth de Clark. She is Barclays Global Head of Technology Investment Banking. We'll also speak with Blackstone's Global Co-Head of Real Estate. Don't miss it. This is Bloomberg.